A report has been released indicating that General Motors is the most at-risk company of losing sales and billions of dollars in profit in China. This comes as a significant market change is occurring in China, posing a challenge for automakers such as GM, Toyota, Ford, and Volkswagen, as China is where they generate a substantial portion of their profits. The report suggests that GM could lose market share and potentially billions of dollars in car sales in China in the coming years. The report, conducted by Greenpeace, highlights the rapid transition to electric vehicles in China and the growing market share of Chinese automakers, like BYD, are gaining ground and taking sales away from foreign automakers, including GM. Chinese consumers are increasingly favoring domestic brands, and there is a growing tide of nationalism in China, which further supports the preference for Chinese automakers. According to the report, GM's current strategy in China puts it at risk of losing 6 percentage points of market share by 2030. This projected loss is relative to GM's average market share between 2019 and 2021. The report predicts that China's switch to EVs will leave foreign automakers with stranded internal combustion engine production capacity. GM is identified as the company with the highest exposure to this risk, potentially leaving approximately 1.8 million units of internal combustion engine production capacity idle. The report also mentions Volkswagen as the second biggest loser in terms of electrification, with 1.42 million units of idle internal combustion engine capacity and a projected drop in market share. The study concludes that industry leaders like Toyota and Volkswagen need to accelerate their transition to new energy vehicles to avoid losing business to all-electric brands like BYD. GM currently has two joint ventures in China, SAIC GM and SAIC GM Wulin. These ventures sell GM's Chevrolet, Buick, and Cadillac brands in partnership with the Chinese government. GM's electric vehicle lineup in China includes models from its own brands as well as those produced by SAIC GM and SAIC GM Wulin. However, these EVs are not performing well in the Chinese market, and GM's overall sales in China have declined by over 25% in the first quarter of 2023. The report suggests that GM and other legacy automakers' days in China may be numbered, and they need to prepare for significant challenges. Potential actions could include declaring bankruptcy and exiting the market, similar to what Jeep did with Stellantis. However, such a move would have a significant impact on GM's profits.